Every few years, the same story repeats. A new opportunity appears. At first, only a few people notice. Prices start rising. Early investors feel like geniuses. Then the excitement spreads. Friends talk about it. News channels talk about it. Social media fills with success stories. Suddenly, everyone wants in. People start buying not because something is valuable, but because the price keeps going up. And that's when things get dangerous. Because at some point, reality catches up. Prices stop rising, panic spreads, and what looked like easy money suddenly turns into massive losses. This pattern has happened again and again throughout financial history, from tulip bulbs to tech stocks to cryptocurrencies. And the reason isn't just economics, it's psychology. Understanding why people behave this way is the key to understanding market bubbles. What is a market bubble? A market bubble happens when the price of an asset rises far above its actual value. This could be stocks, real estate, commodities, or digital assets. At first, rising prices can be justified. Maybe a new technology appears, maybe demand increases, maybe the economy is growing. But eventually something changes. People stop buying because something is valuable. They start buying because they believe they can sell it later for a higher price. That shift is the beginning of a bubble, and once psychology takes over, prices can rise extremely fast, but they can also collapse just as fast. The first stage, a good idea. Almost every bubble starts with a legitimate opportunity. There is usually a real innovation or economic shift. For example, new technology, new markets, new financial tools, major economic growth. At this stage, only a small group of investors notice. Prices start rising slowly. Early investors often make good returns, and because those returns are real, the story becomes more convincing. People begin to believe something huge is happening. Sometimes they're right, but sometimes excitement grows faster than reality. The second stage. The story spreads. Once prices rise enough, people start paying attention. Media coverage increases. Analysts publish optimistic forecasts. Friends talk about the opportunity. Humans are naturally influenced by stories. If we hear about people getting rich, our brains start imagining ourselves doing the same thing. This is where social proof becomes powerful. Social proof simply means people look at what others are doing and copy them. If everyone around you seems to be investing in something, it starts to feel safe, even if you don't fully understand it. At this stage, participation expands quickly. New investors enter the market, prices accelerate, and the bubble begins to inflate. The third stage, fear of missing out. Now a powerful emotion takes over, fear of missing out, often called FOMO. At this point, people aren't just curious about the opportunity anymore, they feel pressure to join. Maybe a coworker made money. Maybe someone online posted huge gains. Maybe the price doubled in a short time. Suddenly the question changes. Instead of asking, "Is this investment good?" people start asking, "Am I too late?" And ironically, this is usually when the biggest risks begin, because many people enter the market after prices have already risen dramatically. The herd mentality. Humans are social creatures. For most of human history, survival depended on staying with the group. If everyone ran in one direction, there was probably a reason. That instinct still exists today. In financial markets, this creates herd behavior. People follow the crowd. When prices are rising, the crowd feels confident. When prices fall, the crowd panics. This collective behavior amplifies price movements. During bubbles, herd mentality pushes prices higher than logic would normally allow. Another psychological force driving bubbles is confirmation bias. Confirmation bias means people search for information that supports what they already believe. If someone thinks an investment will keep rising, they tend to focus on positive news. They ignore warnings or negative data. For example, they watch analysts who are optimistic. They follow investors who agree with them. They dismiss critics as not understanding the opportunity. Over time, this creates an echo chamber. Everyone hears the same bullish arguments. and doubts slowly disappear. The illusion of easy money. During a bubble, making money can start to feel easy. Prices rise quickly. People who bought recently see fast gains. That creates a dangerous illusion. Investors begin believing their success comes from skill. In reality, the entire market may simply be rising. When markets trend upward strongly, many strategies look successful. This leads to overconfidence. People invest larger amounts. Some even borrow money to invest, and that increases the risk dramatically if the market reverses. Eventually, the focus shifts completely. Investing becomes speculation. Investing normally means buying assets based on long-term value. Speculation means buying something mainly because you expect the price to rise soon. During bubbles, speculation dominates. People stop analyzing fundamentals. They start analyzing price momentum. Questions change from, "What is this worth?" to, "How high can this go?" And when that mindset spreads widely, the bubble enters its most dangerous phase. At the top of a bubble, optimism reaches extreme levels. You often hear phrases like, "This time is different." Investors convince themselves that old rules no longer apply. New narratives appear, explaining why prices can keep rising indefinitely. These narratives often sound convincing, but they usually ignore basic economic realities. Eventually, something small triggers doubt. It could be disappointing earnings, rising interest rates, negative news, or simply too many sellers. Once confidence cracks, the bubble becomes unstable. The collapse. When bubbles burst, prices usually fall much faster than they rose. Why? Because psychology reverses. Earlier, investors were motivated by greed and optimism. Now they're motivated by fear. People rush to sell before prices fall further. That selling pushes prices even lower, which causes even more panic selling. The herd mentality works in both directions, and that's why market crashes often feel sudden and chaotic. Why bubbles keep happening? You might expect investors to learn from history. After all, bubbles have happened many times, but the same psychological forces keep repeating. Each new generation of investors believes they are smarter. Each new technology feels unique. Each boom feels justified. And during strong markets, warnings often get ignored. Because optimism is contagious. When people see others making money, logic becomes less important. Emotion takes over, recognizing bubble behavior. While predicting bubbles is extremely difficult, certain patterns appear frequently. Rapid price increases without clear improvements in value. Heavy media coverage about easy profits. A large number of new investors entering the market. Extreme optimism and dismissal of risk. These signals don't guarantee a bubble, but they often appear when psychology is dominating markets. Recognizing them can help investors stay cautious. The rational approach. The challenge for investors is separating emotion from decision-making. Markets will always experience excitement and fear, but long-term investing usually depends on discipline. That means focusing on fundamentals, understanding risk, and avoiding the temptation to chase rising prices purely because others are doing the same. It also means accepting uncertainty. Even experienced investors cannot perfectly predict market cycles, but they can control their behavior. And controlling behavior is often more important than predicting markets. Market bubbles happen when prices rise far above real value. They usually begin with a legitimate opportunity. Rising prices attract attention and new investors. Social proof and herd behavior spread excitement. Fear of missing out pushes more people into the market. Confirmation bias strengthens optimistic beliefs. Easy profits create overconfidence. Speculation replaces rational investing. Eventually, confidence breaks. Prices fall rapidly as fear replaces optimism. And the cycle repeats. Financial markets are often described as machines driven by numbers. But in reality, they are driven by people. And people are emotional. Understanding the psychology behind market bubbles doesn't guarantee perfect investing decisions, but it does give you something powerful: perspective. Because when everyone around you believes prices can only go up, That's usually the moment when caution matters the most.